Welcome to Hedge Fund Tips with Tom Hayes. I'm Tom Hayes, and this is your 287th VideoCast podcast for the week ending April 17th, 2025. Got a lot to cover today, but family first. We'll go through some of the photos of New York back in California here. That's the New York Stock Exchange, never gets old. Super excited. That's me waiting to go on with Diane King Hall on Schwab Network. That's me with Kristen Scholler at the NYSE. That's out in front. That is with Maria F. I'll protect her privacy. She is a professor at my alma mater, Columbia University, and she is a super fan of the podcast. Also has a house in Newport Beach. That is at, and by the way, went to an incredible French dinner. That was a lot of fun. That is on set for Stuart Varney & Co. That was amazing. You can see the teleprompters here that they read at the top of the hour. That was in front of the Fox building. You can see the Fox and Friends show live there. That was took my mother and brother out to dinner in New York City. That was a lot of fun. This was on the new set of Making Money with Charles Payne. He took over the old Cavuto set, has an incredible screen there. That's at the green room for Stuart Varney & Co. That is at Yahoo Finance. That's on the literal set of Making Money with Charles Payne. This was me co-hosting the full hour with Maddie Mills over at Yahoo. That was so much fun. This is Bryant Park, never gets old, right near my place, and that's the fountain from Friends. They just took down the ice rink, put up the new grass. I wanted to pull out my wedge and start making divots, not really. And then want to shout out to Swim, who gave Annabelle a new shout out. Go to swimswam.com. That's like the People magazine of the swimming world, or the Wall Street Journal of the business world, or Barron's. Amazing weekend of water polo at the 2025 Cal Cup State Finals. Lots of wins there. Let's see what else we got here. I got to play with the boys. My friend Damien came down from Santa Monica, and Daryl and Tony are members at my club and friends. So here's this. Okay, Annabelle Hayes of Irvine Nova Aquatic continued to swim fast. Yeah, that's what she does. In the girls 10 and under age group, winning 5 events. Swam personal best to win the 50 free, 26:30, 100 free, 56:60, 200 free, 2.03.33, and 100 fly 1.05.18, while also winning the 50 fly 28.68. Hayes was second in 50 back 29.9, and 200 IM personal best 2.15.90. Among 10-year-olds this season, Hayes is the fastest time in the 100 free, second fastest times in 200 IM, 200 free, third fastest time in 50 free, fourth fastest time in 50 fly, 50 back. Awesome stuff there. Congratulations to all the hard work and results. Then we got a couple goals. We're not gonna cover all of them because we don't have time. Too much to cover. We'll do one Mimi, one Annabelle. Here we go. Mimi. She gets the pass. Boom. Places it. Nice work. And then Annabelle right here. And boom. Places it in this corner. How you doing? That's how we do's it. Good job. And then we've got podcast pick winners. This is from Cole Kettering. Got the Burden Yourself with the Facts hat. Won the contest. We talked about that, so that's exciting. Then we've got these gents, absolutely incredible here. I'm going to get their names in a second. That was from Peter McSherry. Won the hat. Huge fan for 4 years. Never miss a video cast. WhatsApp group with friends talking about the whole thing. So awesome Peter with his friends playing golf. That's how we do's it. Here's another great photo, and this is from Adam Dyer, doing an incredible job here playing golf. We're getting a lot of new young golfers. Pretty exciting. And then, of course, we got Mitch Lim, also with his awesome Burden Yourself with the Facts Great Hill Capital hat. Congratulations to all the winners. Thanks for sending in your photos and let's get down to media. First, want to thank Stu Varney and Christian Dagger for having me on Friday remote before I went out. We're going to listen in here.
Okay, market's still in the red. Thomas Hayes joins me now. Thomas, big picture. Have we seen the bottom yet?
I think we're there or close. There's a saying, Stu, out of crisis comes opportunity. If you look at Trump 1.0 trade war in 2018, the market fell 20% into December. 4 months later, it was at new highs. If you think this is going to take a little longer, we look at the European debt crisis in 2011. Market fell 20%. 8 months later, the market was at new highs. But I think you're there. Maybe you go back and retest. I heard my buddy Kenny Polcari earlier on the show. That's certainly a possibility. But this is the time when you want to be buying high quality businesses for the long term, and keep your head, keep your cool.
Easier said than done. You've got two stocks that you particularly like. Let's start with Boeing. Why do you like them?
Well, in the context on focusing on what you can control and buying good assets when they're marked down, you've got one of the best businesses in the world, a duopoly with a $500 billion backlog. With the new CEO, Kelly Ortberg is turning the ship around just like he did at Rockwell Collins. 10-year backlog. This is a great business, duopoly, and not going to be as impacted by tariffs, simply because if you want a plane, you can go to them or you can go to Airbus, and that's about it.
How about Disney? That's been badly beaten down. It's in a dip. You buying the dip?
There's no question about it. If you can own Boeing under 160 for the long term, if you can own Disney under 90 for the long term, the parks are, decades and decades of a moat. The experiences, the cruise ships, high return on invested capital, and their streaming has shown resiliency, growth, and stability. So we like this business for the long term, and we love it under 80.
Well, it's at 85. No, you mean you love it under 90? Under
90, under 80. Look, Stu, if you look back in 2 years, whether you bought it at $100, whether you bought it at $90, whether you bought it at $85, you're going to look back and pat yourself on the back. This is going to be a lot higher.
Well, that would be nice. Okay, Tom, thanks for joining us. The bell is ringing. That means the trading begins in about 10 seconds.
And we're back. Then I had the pleasure to join Matty Mills on Monday morning. Want to thank Matty Mills, Justin Oliver, Cheyenne Reed for having me on for the full hour. Stephen did a good job cutting 60 minutes into 15 minutes so you can get all the key spots. Or at least I'm pretty sure he did. I haven't spent the 15 minutes to watch the whole thing yet, but you can find the entire hour at the YouTube channel. Go to YouTube, put in the search bar hedge fund tips. You'll see it in the first 4 or 5 videos. Also, while you're at hedgefundtips.com, click on terms. This is all opinion, not advice. Talk to your financial advisor before you do anything.
Well, I do want to bring in Thomas Hayes. He is the chairman and managing member of Great Hill Capital, an equity manager based servicing accredited investors and qualified institutions. He also has a weekly podcast called Hedge Fund Tips with Tom Hayes, where he shares his market insights. And he's going to join me as my guest host for the hour, answering my questions, the audience's questions, and, of course, asking questions to some of our guests. Tom, great to have you in.
Thanks for having me, Maddie. Happy to be here.
So we were just talking about how you do a great job of getting questions in from your audience on your podcast and answering some of those questions. What would you say is the single biggest question you've gotten over the last week or two?
Well, I think people are a little bit concerned about the uncertainty of the tariffs. How long is this correction going to last? When are the lows in? And I think this time it's a little bit different than people worried about the great financial crisis, people worried about the tech wreck. Is this going to continue to cascade? This is man-made. This is not a function of multi-year buildups like you saw in the late 90s with the tech exuberance. It's not a function of excess in the housing market like you saw with the great financial crisis. This started with a tweet. It could end with a tweet. One day you could wake up and you see this beautiful tweet that says, I just got off the phone with Xi Jinping, and the market rallies. 2 analogs I'm looking at, Maddie. First and foremost was Trump 1.0 trade war. We had a 20% correction in 2018. it took 4 months to recover to new highs. And then if we get a little more volatility with all the negotiating, we go back to 2011 and look at the European debt crisis. We have some debt rumblings here with U.S. Treasuries. That took 3 months, and it was extremely volatile. However, once you nearly touched that 20%, the bottom was in. So we're pretty sanguine and pretty constructive to buy stocks at these levels.
And are you suggesting buying stocks kind of across the board, or are there certain areas investors should look at more than others?
Well, I think it's what you want to get in terms of return. So we look for some of the beaten down sectors because we want to get excess return over time. One of the groups that we're looking at is home builders, believe it or not. You can't give them away right now, but we like a gentleman named Brad Jacobs. He wrote a book, How to Make a Few Billion, and it's useful because he actually made a few billion, and he's put $1 billion of his own money in his new project called QXO. This is a building supply roll-up play. If you had invested with him in the past, whether it was United Rentals, if you put $1 million in when he got involved in 1997, you made $79 million to date. If you got involved with XPO Logistics when he got involved, he put $150 million in 2009, you would have made something like $160 million, 160x. So we want to bet with him because the trends are there. You know, as a millennial, everyone's looking to buy houses. They're waiting because rates are high and there's not enough supply. There is a 4 million unit shortage. And as we know, Trump is going to open up federal land. So not only do you get your starter home from KB Homes, you get an endangered elk in your backyard free of charge. But the fact of the matter is supply is coming online. He's going to benefit, and he started off with a company called Beacon Roofing. Everyone needs a roof. When your roof is leaking, it's a non-discretionary expense. You don't think about, should we plug the roof? We replace the roof immediately. Yeah. He bought it at 10 times EBITDA. He kind of paid up, but he's going to add technology as he always does and double EBITDA over the next few years.
And I know another name that you're looking at, CRK, I believe?
Yeah, Comstock Resources. Yeah. Well, guess what? Not only do we have negotiations with China, we have negotiations with Europe. And what do we want to sell Europe? We want to sell Europe our LNG. And Comstock Resources is controlled by Jerry Jones, who also owns the Dallas Cowboys. He's an oil and gas legend. He owns 70% of the stock. We got involved around $9. It's doubled. However, if you look at proven reserves of this company, they're worth about what enterprise value is now, but the real value, the real unleash is unproved reserves. They've got over 15 years of drilling that's not recognized in their financials because they're only required to report PV10. So we think from these levels over the next 24 months, this stock can not only, it's already doubled since we started talking about it. We believe it can double one more time over the next 12 to 24 months. So we love the LNG play. We know Europe is going to start taking a lot more of our gases in exchange for tariff mitigation, and it'll be a very good thing.
All right, 2 stock picks for you from our guest host, Tom Hayes. Tom, you're going to stick with us for the hour. Appreciate it. Thank you so much. Well, President Trump's tariff policies got a little more confusing over the weekend, leaving investors once again uncertain about the market outlook. Our next guest has sectors that are currently offering safety and also has ones to avoid. We are joined here by Eric Bayridge. He is Sound Income Strategies Co-Chief Investment Officer. Eric, great to speak with you.
I absolutely agree with you. On the materials side, absolutely bombed out. We're looking at, we kind of share an affinity here. I can tell you have a value tilt to you. We're looking at Albemarle, for instance. They got $3 billion of excess liquidity. Are there any materials names that you're looking at, Eric?
Well, we own a bunch of them. One that I really like that a lot of people don't because of they're afraid the dividend will be cut is Dow Chemical. It's one of the best companies in the world. Unfortunately, they have had their, and Lyondell, a similar company also in plastics, have seen their demand come down a bit. But I think over a long period of time, those are 2 companies that you definitely want to own. They're both high-yielding stocks, and they have substantial capacity for rebound, both in their margins, volumes, and earnings, as well as, of course, cash flows.
Eric, I got to know about ADT. This thing has been a value trap forever. Before it went private, now since it's gone public again. Give me the growth story. Why is this thing going to come out of this range? Why is this not going to be a value trap? I want to believe. Talk to me, Eric.
That's very easy to sell ADT now because they sold their commercial business, they deleveraged the balance sheet, and their earnings are growing now.
Thank you so much. We got to leave it there. Thank you. Coming up, we're going to take a closer look at some of today's big stock movers, including an incoming litmus test for luxury retail. That's next. the upside. Thomas, we were just talking about some of the regulatory pressure on LVMH, but when it comes to their exposure to China, at least to the Chinese consumer, they could be a beneficiary.
Yeah, there's no question about it. The Chinese government has explicitly stated they're going all in on massive consumption stimulus for the Chinese population to offset any impact from the Trump tariffs. So LVMH is going to be a major beneficiary of that. If I look at my credit card bill every month, 10% is probably Sephora from my 10 and 12-year-old girls. They spend all their free time at Sephora. So LVMH, I think you have to start to look at these companies that benefit from Chinese consumption, because I think the government, we've waited for this China recovery for 2+ years, and I think they've held back this stimulus because they were anticipating the possibility of tariff friction, and this would be a way for them to offset it and to continue to grow. Alibaba will be a major beneficiary from massive consumption, and the Chinese government has explicitly stated we want to get our people to our economy to 70% consumption within 10 years. That is a huge stretch. So companies like this have a long secular tailwind. We'll have short-term volatility and bumpiness, but on red days, and there's going to be opportunity to buy really great companies.
And we should mention, just for the audience, it's really interesting to see China kind of do a U-turn on stimulus, because the government has been very anti-stimulus, obviously didn't offer it during COVID, and now we're hearing them come out and offer this stimulus potentially off the back of these tariffs. So certainly a U-turn from the government there. But let's go next to TMC. It is a metals company and rare earth miner. MP Materials also rising after a report that President Trump is planning a stockpile order. The Financial Times says Trump is drafting an executive order to stockpile deep-sea critical metals in an effort to counter China as the U.S. seeks to become self-sufficient with these assets. So let me give you a little bit more context here. China saying that they are no longer going to be able to export some of these rare earth minerals. That is just the latest retaliatory move from China when it comes to the trade war. And then you have President Trump firing back to the degree that he can, saying, okay, well, we will just start stockpiling what we have available. But as you know, Tom, obviously these are really critical minerals. They go in the likes of motors and cars, obviously chips for phones as well. So it's something that we do need, and it's something that the administration is focused on. Yeah,
there's no question. President Trump believes he holds the cards, but China has one major card here. When you look at a company like TMC, it's an $800 million company. So how much can you stockpile based on their current production? I think this is going to help us get to a sensible place with tariffs, a reasonable agreement where we get more than we had, China gets less than they had, we kind of bridge that surplus. And I think embedded in this, what we're going to find, ultimately it's going to come down to a reval of the currency relationship, Chinese taking the yuan up further to kind of balance that imbalance, and we won't have to put such pressure on tiny companies like TMC to stockpile rare minerals that China has in abundance.
Yeah, certainly a smaller company when it comes to the ones that we talk about here. But let's end with a bigger firm, Sony, announcing price hikes for its PlayStation 5 console across Europe, the UK, Australia, and New Zealand. The company citing the, quote, challenging economic environment, including high inflation and fluctuating exchange rates. The PS5 Digital Edition will now cost nearly $570 in Europe and the UK, an increase of 11% and 10% respectively. And there you can see the shares moving to the upside alongside the broader market by about 2%. Is this just the beginning of price hikes that we're going to start seeing more broadly across the globe?
Well, it must be an amazing franchise to have that pricing power and to say, we are raising prices on our PlayStation because it's a challenging environment. In other words, we don't want to do it, but you need our product so much that even though you're challenged, we're going to raise the price and we're going to do just fine. So you may see some of that across the board. We'll know more in coming weeks and months as this thing gets resolved country by country. You had Hassett on earlier this morning talking about maybe some package deals, getting a bunch of countries done at once. You start getting that stuff hit the tape, and this bottom in the markets could be durable. Let's see how it comes in coming days and coming weeks.
Let's certainly see it. It is fascinating. I've spoken with sources before who've told me that these consoles, these video game players, there's not like an off-brand version, so they do have a lot of that pricing power. To your point, Tom, you're going to stick with us for the second half hour of our show. And by the way, you can scan the QR code to track the best and worst performing stocks with Yahoo Finance's trending tickers page.
So I have a question for Andrew. What do you see CEOs doing? What's their strategy? Are they saying, we'll just wait it out and eat it for 3.5 years? Are they going to stand up factories in the U.S.? And then what happens if policy changes 3.5 years from now? There's a lot of confusion. How do you play that? And do the big get bigger as the smaller players just go out of business? Or how are you thinking about it? How are CEOs thinking about it from large companies to small companies?
So there's still a lot of uncertainty.
Marco, when do you think we're going to see the pivot from the uncertainty of tariffs to the opportunity for growth with tax cuts, deregulation? In other words, package this up like Kevin Hassett was talking about this morning, maybe packages of countries all at once, put the pain behind us, and now focus on growth, deregulation, tax cuts, et cetera. When do you anticipate seeing that pivot?
It's very hard to tell, right? I don't think, as I said, I don't expect uncertainty to dramatically decrease in a very short time. I think uncertainty is here to stay.
Are you shifting your allocation to ex-US, or you haven't made that decision as a firm yet?
We haven't made this decision yet. I will not talk about specific portfolio allocation here, but there is a sign that something may have changed. Well,
so coming into earnings, are you comfortable with the valuation, 37 times forward? You got a $400 billion enterprise value on $7 billion of free cash flow. You know, that kind of compares to Disney, for instance. They've got $8.5 billion of free cash flow and maybe $190 billion enterprise value. Oh, and by the way, you get the parks and you get the experiences and you get the cruise ships for free. Just talk about what that means in terms of exceeding expectations, and now that they're not reporting subscribers, and you've seen Disney kind of stall at 178 million subscribers, and Netflix maybe stall at 300 million subscribers, what are your thoughts on the relative value?
I mean, it'll be interesting to see how the fundamentals actually shake out and what kind of commentary we actually get from senior management. They're going to guide the market. They're going to give us that strategic conviction in terms of whether we believe the bulls or the bears, like whose assumptions do we go with? Yeah. And in terms of Disney, we can't forget that they have a substantial amount of their business in the Far East. Mm-hmm. So they are also exposed. Mm-hmm. And, you know, I think net, it'll be interesting to see who's the bumper in this.
Yeah.
That's over at Great Hill Capital, and Tom has a question for you.
Yeah, Andrew, so reusable rockets is the name of the game. What's your level of confidence? Obviously, Falcon 9 has done thousands of missions up there and brought satellites up with no problem whatsoever. Then you've got Boeing with Vulcan. They've had 2 trips, so that's a positive. And then you've got Blue Origin with New Glenn just doing 1 trip. How do you expect that competition to accelerate over the next couple of years? And kind of what are your heaviest weights in the ETF that are playing the space theme?
Yeah, so launch is extremely important. And yes, it's been great for getting costs down, but you do have more players coming out. You look at what Amazon is doing with Project Kuiper, and they didn't just sign up Blue Origin to be a launch provider to get their satellites up into space. They actually contracted 4 different companies for, I believe, about 80 launches scheduled over the next several years.
Thank you so much for joining us. Really quick, Thomas Hayes, want to get your thoughts. Final 30 seconds of the show. We're still seeing green on our screen across the major averages. How much can investors trust this relative optimism today?
You can't trust it on a daily basis, but focus on what you can control. When the market's marked down like this, if you focus on buying high-quality companies that are marked down, one of the companies we were buying last week aggressively was Disney at $85. You don't have to think hard about Disney. Mm-hmm. It's down from $200. Over the next few years, it's going to recover. Tariffs or no tariffs, it's going to be okay. Boeing was a company we were adding to. It got down to $129, down from $350 some odd dollars. This is a duopoly in the aircraft space. So if you buy great companies and you have a long-term view, 12 to 24 months, you're going to do great out of this opportunity.
To that end, NVIDIA was under $100 a couple weeks ago as well. So certainly something to keep in mind. Thank you so much, Thomas Hayes of Great Hill Capital, for joining us. Appreciate it. Coming up, we've got wealth dedicated to all your personal finance needs. Brad Smith has you for the next hour. Stay tuned.
And this was BBC that same night. Want to thank Adam Hancock for having me on that. That I'm going to ask you to watch on your own. You can find it at the website or at the YouTube channel. We're just trying to conserve time here. That was a good one. Want to thank here, I'd like to thank Nicholas Palazzo and obviously Charles Payne for having me in his new studio in person. Someone asked me, how tall am I? Look, I'm 6'5". Charles is also a tall man. I think it's camera angle because I've stood with him at his old prompter screen back in the old studio, and it didn't look this one-sided here. So if we were gonna play one-on-one basketball, I'd bet on Charles here. Not only is he tall, he's fast and he's smart, but really enjoyed. We're gonna listen in here.
It will never be the same. They keep pouring cold water. I mean, here's what the big thing was last week. Don't look for a V-shaped rebound, right? I do like this though, because Fundstrat put this out. Really great table. They show historically, right, of the 11 bottoms since 1929, 7 actually did have a V-shaped recovery. So I want to bring in Great Hill Capital Chairman Thomas Hayes. And Thomas, so many observers, are saying investors were spoiled by this one. 2020, it was the sharpest bear market in history. It felt, COVID, we're never going to make money again. But it also was an amazing V-shaped recovery. And throughout almost all of it, everyone would come on the show and say, everyone was skeptical. It can't be. It can't be. It's premature. It can't be. But it was the ultimate time to buy stocks. Where are you in this camp? Like V-shaped recovery, W-shaped recovery, a recovery?
Yeah, we're looking at two things. First off, the dumb money is the new smart money. They've been buying in the hole while hedge funds have been record sellers in the hole. We're looking at 2018, the trade war 1.0. You had a 20% correction. You were at new highs within 4 months. That's the V-shaped recovery. That's a possibility still. It started with a tweet. It could end with a tweet. Imagine you got a tweet tomorrow. Just got off the phone with my friend Xi Jinping.
Right.
We're off to the races. The other one is 2011, the European debt crisis. You had the 20% correction like we just had, but you had 3 months of nonstop volatility, and it took 8 months to reach new highs. So you're using these opportunities, you're being smart to selectively buy high-quality companies on red days.
So I want to get your thoughts on that. I want to follow up on that because there are different types of bear markets, right? Yeah. Structural, cyclical, event-driven. Structural are the ones that last the longest, are the ones that are hardest. They have the longest length, the longest time to recovery. Event usually go down the least, the shortest period of time, and they recover pretty quickly. I don't know what to call this. I don't even know what this category is that we're in right now.
I think this is event-driven because we're going to shift from this. We're going to start to get packages, like Kevin Hassett said this morning, of multiple countries at once. And then we're going to shift to tax cuts, deregulation, and growth. Right now, we're paying the piper. In another few weeks, another few months, we're going to be talking about growth, acceleration, recovery, and everything else.
I was reading where you're telling investors, focus on what you can control.
Yeah.
What can they control?
Yeah, I learned early on in the business, good things happen to people who buy high-quality companies at low prices. And that's all you can do right now. On every red day, you look for an opportunity to buy great businesses. Last week, Boeing got down to $130 a share. Disney got down to $85 a share. These are down more than 50% from their peaks. These are things you can go to bed, wake up, not even having to worry about.
You got two new ideas, too, that you're sharing with this. QXO. I don't think a lot of folks are familiar with this one.
This is Brad Jacobs' new roll-up. It's a building supply company. This guy knows how to make money for shareholders. If you had invested $1 million with him when he did URI, you made $74 million to date. If you had done the same exact thing with QXO in 2009, you made $160 million. So we've got 4 million units housing shortage in the U.S. Donald Trump has said we're opening up federal lands. Not only do you get your starter home from KB Homes, you get an endangered elk in the backyard free of charge. They are going to be supplying. They just did Beacon Roofing Supply. They paid 10 times EBITDA. He's going to double that EBITDA with technology, with tuck-in acquisitions. This is one you buy, you tuck away for 5 to 10 years, and you're going to wind up with an 8 to 10 bagger.
And Comstock?
Comstock we gave on your show January of 2024 around $9. It's now up double. We think it can double again. Why? Part of the negotiations with the EU are going to be about, we'll lower your tariffs. You're going to take all of our LNG. Jerry Jones owns 70% of this stock. The unproved reserves are worth another $20 a share. We like this here.
I love how thorough your work is.
Thank you so much.
The track record ain't bad either.
Yeah, thank you, my friend.
Good stuff. We needed you today as well, Thomas. Hold on there. All right, folks, so trade uncertainty. We came out the gate strong. Then the New York Fed came out with their inflation data. We gave a lot of it away. And then a Fed spokesperson spoke up. Pretty highly recognized Fed spokesperson. Now you can see some more green on the screen. We're bouncing all around, but is this the moment that you go for it, that you take your shot, particularly on those tech names? We've got a very special tech guest next. We'll be right back.
And then the next morning on Tuesday, I had the pleasure to join in person Stu Varney and talk about the administration. This one's worth, you got to check it out. Want to thank again Christian Dagger and Stuart Varney.
Thank you very much indeed. Tom Hayes is joining us this morning to cover the market for us. Tom, welcome to New York. It seems the market depends almost entirely on tariff news. Every day, give the latest tariff news and then you get the market reaction to it. Yeah. Can we go up? Can the market go up if we're continually whipsawed by tariff news?
There is uncertainty, but I just want to say about the Chinese rejecting Boeing aircraft is like a diabetic rejecting insulin. They need our planes more than we need their sales, that's for sure. I think, look, in the kingdom of the blind, the one-eyed man is king, okay? The countries that come to the table first and sign the deals first are going to have certainty. There's an enormous premium on certainty for your economy. That's on the one side. On the other side, Kevin Hassett was on the network saying, yep, we've got bundles of deals. Well, the administration needs to take yes for an answer, because the minute we take yes for an answer, it shows that we're ready to do business. We don't need to have self-inflicted pain. What we need is some certainty with the deals so we can get focused on earnings, growth, and tax cuts.
Yeah, if we get tax cuts and we get some certainty on tariffs, if we do, you've got a market that goes straight up, do we?
That's right. You know what? The market is a discounting mechanism. The minute we see those bundles of deals come across the tape, companies can start to give guidance. Once companies can give guidance, we have some level of certainty, and there are a lot of tremendous bargains in the market right now. Money is going to want to go to work as we get a little bit more certainty.
All right, Tom, thanks very much for analyzing the market this morning. We appreciate it.
Thanks for having me.
And we're back. And then on Wednesday morning, I had the pleasure to join Diane King Hall on Schwab Network. Want to thank Heidi Schultz and Allie Thompson for having me on. This was a great one. Really enjoyed talking with Diane as always.
So we had a lot of volatility last week. This feels like a little bit more normalcy now, or at least trying to kind of figure out how do we get back to normal. You pointed out that this is the first correction where seasoned pros seem more fearful than retail investors. I'm surprised to hear that, but how did you arrive at that assessment?
Yeah, well, incoming phone calls. I mean, I have peers in the business that were calling me in literally abject fear, and me kind of walking them off the ledge and saying, this too shall pass. You know, if you look at the data, retail investors have actually been buying in the hole on this correction, and hedge funds have had record selling in the hole. And what's interesting about that, most people would say, well, the dumb money, smart money. Let me tell you something. The retail investors have been right since COVID. They have been buying weakness while professionals have been selling weakness, and the retail investors have been correct. And I think this is going to be the case again.
But was some of that fear warranted? I'm not saying one should feed into fear, but like when we saw that volatility last week, obviously we've cooled since then on volatility. When we look at the VIX, it's not at those historic levels that we saw. But, you know, when you're in this daily, you've experienced that turbulence before, it does kind of triggers a memory that wasn't great.
That's right. That's right. Look, the administration has to learn to take yes for an answer. Okay, they have deals on the table, or as Kevin Hassett would say, bundles of deals on the table. And all they need, what you need to see is one credible deal roll across the tape, and then the market will realize there's some rationality in the administration. They're going to move ahead. Things are going to be okay. We're just in the period of uncertainty, and the way that you get through that is you focus on what you can control. And all you can control is buying high quality businesses when they're on sale. I learned very early in the business, good things happen to people who buy high quality assets when they're marked down. And you know, irrespective of how long it takes to get a deal, if it takes, so here's two analogs. Trump 1.0 in 2018, trade war. Market corrected 20%. It recovered V-shape within 4 months to new highs. Could that happen? That's a possibility. We're slightly more in the camp. It's going to be like the 2011 European debt crisis, where you had a 20% correction.
I remember that,
and then 3 months of hell, nonstop volatility, and then 8 months later you were at new highs.
Really quickly, I know you've got a couple of picks, but I want to ask you that point about volatility. Although we're not at that level that we saw last week, which reminded people, secluded of the GFC. Is volatility here to stay? Or at least during this presidential term?
Yeah, well, the history of President Trump is volatility followed by upside resolution. And that's his formula. He knows how to push it to the edge and then break through and the market resolves higher. So I think you just have to, on a company by company basis, buy quality that you don't have to worry about, not speculative stocks. And we're going to find we'll wake up one morning and he says, I just spoke to my good friend Xi Jinping, and the market's up 5,000 points.
I know, he does call him his good friend. I mean, it's an interesting characterization there. But, okay, let's talk about your picks, especially given your views on how you want to buy things where you see opportunity, potential sale. CRK is on your list, Comstock Resources. Now, you picked this a year ago, or a little more than a year ago, right? It's been a winner since then, up more than 100%. Why are you still bullish? Where do you see it going?
I think part of the tariff negotiations is, particularly with Europe, is going to be, you want a reduction in tariffs, you need to take all of our LNG. Okay, they need our LNG. We have it in abundance. They need to take it, and they're going to want to do that deal. Comstock Resources, 70% owned by Jerry Jones, who owns the Cowboys. The proved reserves that they report to the SEC, which is 10 years of drilling, are worth about $8 billion. The enterprise value is around $8 billion. However, their unproved reserves, which they do not report, is another 15 years of drilling. Okay, so we think that's worth about $10 billion, which means we think not only it doubled since we talked about it, we think it can double one more time over the next 12 to 24 months.
Is there still a push for LNG given the Trump administration's not the same focus on converting to more I'm trying to find the word how you care. I mean, it's considered a better for the environment.
That's a good question. You mean he'd prefer coal?
Yeah.
Well, look, you can't make it up. I think he wants everything, and we're going to need everything to power the data centers, to power the increased demand, whether it's EVs, whether it's data centers, unlimited demand and globally unlimited demand. So that's a great way to play it. Okay,
your next ticker, QXO. Now, look, that's a different pick than this in terms of its performance. I mean, with Comstock Resources, that's outperformed the S&P 500 this day. But QXO, this seems like a little bit of a where does it go?
Yeah, this is a relatively new position for us. This is Brad Jacobs. Brad Jacobs is a winner. He makes money for shareholders. If you had invested $1 million with him when he started United Rentals in 1997 when he got involved, you're up 70 some odd X, 74X, $74 million. If you did XPO Logistics in 2009, he came in, he put $150 million of his own money, bought stock. You're up 160%. 1 million became 160 million. Now he's doing a roll up, same formula, different industry in building products. You got 75 million millennials, 34. They want to buy houses, they can't afford them. So Besant's going to deregulate banks, bring down treasury yields below 4%. Okay, that's hopefully the good way, not through a recession, but the good way. That will make housing affordable. And Trump is opening, we've got 500 million acres of federal land. He's opening that up to build all these starter homes. So KB Homes will build your starter home. You get an endangered elk free of charge in your backyard. And Brad Jacobs is going to provide all of the building supplies. He's going to do a roll-up. He's going to add technology. He started with Beacon roofing supply. When your roof is leaking, it's a non-discretionary expense. You don't think about, should we buy a new roof?
You have to.
You have to buy a new roof.
I mean, you can patch it, but
So the history of Brad Jacobs is you put money in, you don't think about it for 5 to 10 years. And this will be 5, 6, 7 bagger at the least. And if history is any prologue, it'll be a lot more than that.
Okay, potentially a 10 bagger.
I think so. Yeah, I'd always bet on Brad Jacobs.
Okay,
he is serious
on Brad
Jacobs. Look, he wrote a book, How to Make a Few $1 Billion. That's pretty useful because he actually made a few $1 billion.
Okay, all right.
And last but certainly not least, I really enjoyed this interview with Kristen Scholler on NYSE Live. Want to thank Kristen, obviously, and Mel Montanez. No relation to Tony Montanas from Scarface whatsoever. Mel is fantastic. Mel and Kristen are the dream team. We'll listen in here.
Welcome back to NYC TV Live, everyone. I'm Kristen Scholler here in studio. Well, stocks are looking at a negative open after what was a muted action yesterday, and of course, 2 straight days of gains for the S&P before that. Well, joining me now with more on where we're headed from here and how investors should respond to all of this is Thomas Hayes. He's a chair and managing member at Great Hill Capital. Thomas, always great to have you.
Great to be here, Kristen.
All right, so what do you make of all this market action of late?
You want the good news or the bad news?
Let's start with the good news.
Okay, well, the good news is the same as the bad news, and that's everyone is pessimistic, okay? So you saw the fund manager survey from Bank of America this week. Highest expectations of a recession, 4th highest in 20 years. So we're talking about 2022, we're talking about 2020, we're talking about 2009. Most number of managers wanting to go underweight U.S. equities. So usually that's a washout. And what we're seeing is the quote unquote dumb money is now the new smart money. Retail investors have been buying a ton of stock on this weakness. Hedge funds have been record selling in the hole. And oddly enough, retail investors have been right since COVID.
So let's talk about what these tariffs mean for companies and how companies might respond to them. Of course, we're at the beginning of earnings season. Thomas, what's your expectation, especially when it comes to guidance?
That's the big deal. I mean, the big problem is companies can't guide in this period of uncertainty. And Kevin Hassett was on one of the networks yesterday, or 2 days ago now, saying we have bundles of deals with amazing terms. Well, my message to the administration is, how about taking yes for an answer? You saw Vietnam come to the table and they said, we'll do 0 tariffs if you do 0 tariffs. I understand there's non-tariff barriers, but what the answer should have been was, we accept in principle contingent upon working out the non-tariff barriers. Instead, they did not. And what happened? China went to visit Vietnam and they just inked a deal. So you snooze, you lose. I think the administration has a lot of good things going. They should book one deal, and that's going to give companies more certainty to say, hey, here are our 3 guidance scenarios. If they continue to do deals, good things are going to happen. If they don't, medium things are going to happen. And if they really don't, here are the bad things that could happen. And then the market can kind of get their hands around it. But right now, we're just shooting in the wind.
So we are probably down still about, let's say, 14% roughly on the S&P 500 from a recent high.
Yeah.
Do you think it is range bound until we get a little bit more certainty?
Yeah, we have 2 frameworks. One would be Trump Tariff War 1.0. In 2018, you had a 20% correction.
Yes.
And then you were at new highs 4 months later. That's a possibility. We would love that. The second scenario that we're looking at is the 2011 European debt crisis, 20% correction, and then 3 months of hell, choppy volatility. Even though the bottom was kind of in marginal new lows, it was literally up and down every day for 3 months of uncertainty until Mario Draghi came out and said, we'll do whatever it takes.
Right.
So we need one of those moments. So either way, but even in that case, 8 months later, we were at new highs. So I learned early in the business, Kristen, good things happen to people who buy high-quality businesses when they're marked down, and I think this time will be no different.
What are some of the high-quality names, Thomas, that are on your radar?
Yeah, I think, number one, don't give up on PayPal. Everyone is down on PayPal. It's kind of round trip. It shot up to 90. Everyone's like, woo, we're up 50%. Now it's back down in the 60s. They're generating record free cash flow. $7.5 billion. They'll probably do $7.5, $8 billion. They're going to buy back 20% of the company in the next 2 years. Alex Chris came from Intuit. He ran 50% of the revenues. He had a 30-bagger while he was running the small business division there. He's going to do the same things for PayPal. PayPal's down because EU said, oh, you're going to tariff us, we're going to tariff your processors. And people shoot first, ask questions later. The fact of the matter is the deal is going to be very simple with the EU. You take our LNG, we'll lower your tariffs. They won't tariff our processors. All will be well. Alex Chris is going to run this up the flagpole. You see Will Ferrell on the TV commercials. They're rocking and rolling. They've got 430 million active users. This is a huge business. Every time you take an Uber, that's actually PayPal. You don't even know it. It's called Braintree.
Interesting.
Yeah.
Another energy company I know has been on your radar for a while as well. What's the latest on that?
Yeah, so Comstock Resources, it's a double since we started talking about it. That's over a year ago. We think it can double again, and here's why. $8 billion enterprise value, the proved reserves, PV10, that they have to report to the SEC, 10 years of drilling, is worth about $7-8 billion, so that's good. The unproved reserves, which they don't have to report, is about 15 years of drilling. We estimate that's worth about $10 billion. So we think it can double one more time from here. And it's perfectly in line with the Trump administration initiatives of drill, baby, drill, massive energy, powering the data centers, and now, of course, servicing Europe.
Yeah. I do want to ask, Thomas, the lessons from 2018. I think there are real questions out there. You know, obviously the president can call shots at warp speed, but for an entire supply chain to adjust to that, and consumers, you know, they obviously can't act as quickly as the president, we presume.
Yeah.
So what are those lessons learned from 2018 that might apply to this scenario today?
Yeah, the lessons of Trump 1.0 and 2018 are excess volatility followed by resolution to the upside. That's the way he rolls. So he throws out these grenades and everyone ducks for cover, and then when he realizes there's enough pain, he goes in and he fixes the problem. And I think what you're going to see is, as you see 1, 2, 3 tape bombs, look, you're going to wake up one morning, everyone's pessimistic, and you're going to see a beautiful truth or tweet, whatever he wants to call it. It's going to say, I just got off the phone with my good friend Xi Jinping, and the market's up 5,000 points, and you're stuck, you know, in cash, and you say, I missed it. So I think it's selective buying. It's not wholesale buying. It could take longer than we expect. Deal with the volatility as it relates to supply chains. We just need to see one deal hit the tape, and then they can get a little more comfort. There's some rationality. We can slowly move ahead. But yes, people are slightly on pause, and that will have an impact in economic numbers in the first couple of quarters for sure.
All right, Thomas Hayes, he's a chair and managing member at Great Hill Capital, joining us in studio. Thomas, thank you.
Thank you, Kristen.
It's great to have you.
Likewise.
And we're back. Let's get down to want to actually talk about something. You know, people have been asking me about gold. I am hearing rumors that, you know, we've got, and by the way, do not act on any of this, because the same places, it's slightly better than a coin flip. I think it seems a little premature, but if true, we'd all be smiling so wide we could eat 3 bananas sideways. So let's see what happens. Here's what I'm hearing. It's in line with what I've been saying. So it's not news, but you know, we've had 14 days since quote unquote Liberation Day. And, you know, Hassett and co. have been out saying we've got, you know, bundles of deals, 75 countries begging us for a deal, yada, yada, yada. Good talks with Japan, good talks with everyone else. All right, so, you know, book it. You know, what are you guys waiting for? And what they're waiting for, and again, this is just, you know, maybe a hair more than a coin flip probability. I'm hearing that it could be a grand package deal that they're trying to put together, which would include tariffs being slashed in exchange for, one, opening your markets, you know, fairly, open your markets and remove the non-tariff barriers. Number 2, increase your defense spending. Number 3, invest in U.S. manufacturing. Number 4, buy treasuries. Number 5, help contain China. Number 6, potentially deval the dollar. Remember, we talked multiple times about a potential for a Mar-a-Lago Accord. And if that proves to be true, and they're miraculously able to pull it off as quickly as the weekend, which, who knows? To me, it sounds premature and early. Could just be people that are stuck trying to create rumors to get out of positions. But it does rhyme with everything that we've been kind of talking about on this podcast. Gold is sniffing that out, the possibility of a deval. And if that's the case, and they do announce something like that, in my view, that would probably be the top for gold, obviously the bottom in the market. So just something to consider, not really something you can act on because it's not done, okay? And nothing gets done until one man says it gets done, apparently. So, but it would make sense why they wouldn't at least announce 1 or 2 deals when they've got so many countries coming together. And if that is the case, That is a great thing. I'd be a little surprised if it was as soon as this weekend. It seems like an awful lot to get done in a short period of time, but I'd be open to it. Let me tell you that. And for all the clients that are in, by the way, congratulations to everyone who came in. Congratulations to all the new clients. We named a bunch of them last week. All the existing clients who put money in when it was down the most last Tuesday and Monday after we did our special private client call. And new clients that came in over the transom in time for our closing on Saturday. So super job. And that's kind of the good news. You can probably leave it there and go watch football games now and color Easter eggs for your kids. But let's go back to the S&P 500, because again, when fundamentals are thrown out the window, you have to look a little bit at technicals. And let's take a look. If you recall, we talked about a quote unquote double bottom. I had to walk my friend off the ledge the other week, and quite a few others, by the way. But that's okay. You know, that's what bottoms look like, and even the best have reason to get scared because it's man-made. You can't handicap it. It's not years of build up and then you can say, oh, okay, it'll take 24 months and we'll be back at new highs. So when it's man-made, a tweet creates it, a tweet can solve it, or an accord or a grand package overnight. And if you're caught flat-footed in cash or whatever, you can never get it back because you wake up and it's too late. So this double bottom is still holding. I think last week we were kind of here and everyone was despondent. Then we started to rise. People got a little happier yesterday, pulled back. But in the scheme of things, didn't really pull that much. This is still holding for now. Everyone is looking for the retest. Maybe we get it. Maybe we don't. If we get that package over the weekend, again, probably a coin flip, maybe a little more than a coin flip, then there's no way we're going back here. If we don't get it, that wouldn't surprise me. And it could be the 2011 scenario we discussed, 3 months of hell, chop most of the pains in, but you just wait, killing time for 3 months until they get their act together. Or if we get this weekend, it could be like 2018 back at new highs within 4 months, which would be unbelievably exciting. So I'm just trying to throw this perspective out. Literally, by the way, off the plane late last night, super early out here in California. So if I sound like I'm on a lot of caffeine, you're perceptive. Let's just leave it at that. Put call, Trin. By the way, taking the girls, Caitlin and I are taking the girls to Hawaii on Friday tomorrow for a week. So we'll do it how I like to. I'm going to play a lot of incredible courses. Half day work, half day play. Girls have been wanting to go to Hawaii forever, and apparently on the West Coast, Hawaii is the Caribbean as we relate to it on the East Coast. I guess Cabo and Hawaii are the Caribbean like we have on the East Coast. So very excited to show them that. Haven't been there. Caitlin and I were there before we got married. So my goodness, 17, 18 years ago. That's time flies. Certainly when you're having fun, and give Caitlin credit that we have had a lot of fun together, and we'll have another week of great memories with the kids. All right, skew, that's down. This is, these are, when skew is washed out, these are the times when you need to worry when skew's elevated, and we were noting that, this was likely. Okay, and we talked about that, buckle up, buttercup, February, March, blah, blah, blah. This 10% move was likely. This overshoot has been unlikely, but I think it's going to get resolved relatively quickly like 2018. So we were kind of fine to ride or die this. This was unnecessary, to be honest. But all things considered, it's like sending Xi the Christmas card, even though he doesn't celebrate Christmas, is going to be sending Trump, because we put literally record amounts of money to work last week, even more than we put to work in October 2022. And I said last week, if you're on the fence, you need to come in, because number one, I've never asked anyone to invest. I've always just put out value, and good people find me after they see the framework, make some money with my ideas, or their referrals from existing clients. But there were 2 times in my career that I told people, now's the time, if you're on the fence, to either put more money to work or to come in fresh. One was October 2022, and one was last week, and in this range right now. So there's that. Let's see how it plays out. I know how it plays out the long term. How does it play out in the next few days or few weeks or few months? We covered the different scenarios last week. You can see some great companies on sale. Chevron getting knocked down. That's probably getting interesting. Nike, same story. Disney, Intel, all this stuff. Once you get an announcement, the whole framework of investor thinking is going to change, and it's going to change super, super fast. So just enjoy the buy one, get one free sales. And one day you wake up, I don't know if it's Monday or 5 Mondays from now or 12 Mondays from now, but the Intels, these are the environments that I absolutely live for. Okay. So want to thank, I think I've got the Slumer put somewhere else, so that we'll get to that in a minute. Thanks, Steve, for just sending this over. This is Albemarle, and we've covered the overlay of lithium prices to Albemarle in the past. They got $3.5 billion of excess liquidity to ride or die. And this is when Albemarle's dividend yield gets around 3%, the stock price tends to bottom. And that's exactly where we are right now. And my response to Steve was, we don't own enough. And, at some point you have position limits, we own enough, but you never own enough once it starts turning, and that's just the way it works. So thanks, Steve D, on that. Urian Timmer, been at Fidelity for 40 some odd years. He had an interesting tweet. Easy to forget just how many 20% drawdowns we've had just in the last 5 years. We had a 28% decline in 2022, 35% in 2020, 20% in 2018. In other words, every 2 years, the market suffers a large drawdown, and it has come back every time, sometimes quickly and sometimes slowly. So that's just putting things in perspective. Returns after 15% drawdowns from Ritholtz. 1 year later, 83% positivity rate, up 15%, 3 years up 40, 5 years up 66, 10 years up 158, 185. This isn't fun, but it happens, from Carson Research. Number of corrections in bear markets since World War II, 25 of 10 to 20%, what we just had, 7 of 20 to 30, 3 of 30 to 40, and 3 of 40% or worse. Foreigners selling U.S. equity funds, selling in the hole, just like they did during COVID. Really not a good time to sell. China's March lending jumped on government stimulus push. That is going to be the unintended positive consequence. We're going to cover all the delisting in detail today. We covered some of it in the article, so just chillax. Energy positioning, getting to levels where we continue to want to look for more. We're very happy with our Comstock, as you can tell. But there will be other things to do. Historical Morningstar equity research coverage, price to fair value estimates at month end. So they're trading at price to fair value levels that you really only see at big drawdowns, and usually they inflect from these levels. So Morningstar does a really good job on their fair value estimates because they're Buffett acolytes. It's a Midwest firm. They're always there. The founder is friends with Buffett, friends with my first boss, who was friends with Buffett for 40 years. So I know all these guys. They do really good work. And okay, now we got U.S. exceptionalism theme, a long way to unwind. Yeah, and this has been kind of coming into the year. We said ex-US, this is going to converge. You're going to see outperformance. Doesn't mean US is crashing at all. It just means underperformance. Why? Because of Mag 7. All the themes that we covered in the fourth quarter that got you ready to be out of Mag 7 before the first quarter have played out. International was crushing it on a relative basis. Some 60-point spread. It's probably still not far from that. outperformance, and that will come back after any type of package is announced. Expectations for dollar depreciation highest since May 2006. This was another theme. Dollar would continue to weaken. That is playing out. As soon as package is announced, EM will rebound back quickly. Options traders bet on rally to 120. That is on the euro relative to the dollar. There you go, ladies and gentlemen. Chinese exports up ahead of U.S. tariff hit. By the way, for all the new people, we have a ton of new people. My longtime fans and awesome partners here know all these things that I said 3 months ago, 6 months ago, etc. You can go back to the archives and pull up any date and see what we were saying and kind of how it played out at your leisure. Chinese exports up ahead of U.S. tariff hit. So a lot of pull forward. That's going to help. Obviously helped with U.S. car sales as well. Help with Baba's earnings, I'm sure, in the first quarter. So we'll see how that works out. 42% say gold is best performing asset in 2025. That's part of the reason I think that if they announce a grand package and a currency deval, gold is sniffing that out. And once it's actually announced, buy the rumor, sell the news. Watch out below. Record number of fund manager surveys intending to cut U.S. equities. That's what they always do in the hole at the exact wrong time. Record 2-month rotation out of U.S. stocks. That's probably a theme that will persist. Relative value of ex-U.S. FMS cash surges to 4.8, selling in the hole. Record by hedge funds. Retail have been buying. Retail have been right since 2020 COVID. S&P liquidity has deteriorated recently. That is another indication that I think what you're going to have to see is the Fed will go back in. They may not cut right away, but they are going to go back into quantitative easing and call it something else to keep the liquidity going. Unless a deal is announced, the liquidity will come back naturally. Total net call volume, they couldn't get enough in January. They couldn't, you couldn't give them away in April. Well, what does that tell you historically? Last time was Q4 2022 when you couldn't give them away. That was the best time to buy them. So I don't know what else to tell you, ladies and gentlemen. I mean, this stuff is not rocket science. Even though value stocks, valuations remain okay. Even though value stocks have outperformed year to date, valuations remain significantly attractive. That was one of our other themes. The final theme is going to be small caps. That hasn't worked yet. It is going to work in spades, just like the dollar took a little longer. Watch out above, not below. Volatility spikes have been opportunities. That, by the way, that requires a package. That requires tariff mitigation. That requires all that. But I think it's coming. And, for a guy who wants to be on Mount Rushmore, if he can pull this thing off, it will be unreal. No one's been able to do it post-World War II. So, who knows? We'll leave it at that. Volatility spikes have been opportunities. S&P average forward price return 1990 to April 2025. Forward periods from when VIX level triggered. And that is from periods when VIX weekly closed above 45. And you can see that 1 year out, you're up 34.2%. 2 years out, which point of this chart is we just had that. 2 years out, you're up 51%. 3 years out, 50. 5 years out, 112. 6 years, 10 years out, 220%. So hang tight, ladies and gentlemen. Inflation expectations highest since June 2021. Okay. Net expecting higher short-term rates. Fascinating. This has a tendency to be right, and this has a tendency to be at or near peak inflation for the short term. So that's fascinating. Global new model launches. Oh, for cars. Oh, a lot of new cars, a lot of exciting cars coming out. That's good to see. Foreign central bank, which means they're going to flood the lot soon. They've taken down inventories huge, by the way, in the last few weeks ahead of the tariffs. This is going to be such a great thing because all you see is incentives. So now the ATP, average total purchase price, has come down because of all the incentives and because everyone trying to get ahead of tariffs. Once they do a package, The incentives are going to be expected, and the volumes are going to have to replenish the thing. So hang in there on Cooper Standard. I know some of you are getting your panties in a knot, but chillax. We're going to be okay. Foreign central banks, smart money, record outflow, foreign demand for U.S. stocks. So again, just like they sold in the hole at COVID, they're doing the exact same thing. Here is one of the most volatile weeks in history. You see the average true range and these levels, 5-day average, tend to coincide with major bottoms. Trump, NVIDIA commits to invest $500 billion. And then he kind of stuck the knife in their back the next day. That's it's just the environment we're in. VIX, can we go wrong buying the S&P 500 with VIX greater than 50? No, we just looked at the data. Great financial crisis, COVID. That's the time to be a buyer, not a seller. I don't think it's a wholesale buyer. I think it's a select bespoke buyer, but a buyer nonetheless. U.S. exceptional theme has peaked. We agree, not because U.S. isn't the greatest place in the world. I think it's just going to be a reversion from 7 stocks to 500 stocks. And the 500 stocks represent regular Americans, lower middle class, wage earners, doing a lot better than the investor class who have been jammed into these 7 Mag 7 stocks that just got their asses handed to them. And have no international exposure to offset that. They're going to be the ones that are going to do less well, and the ones that are going to do really well are going to be the ones that are diversified, ex-US, international, and small cap value, all the themes we've covered, as well as regular Americans. And that's when the country hums, is when everyone participates, not just a few at the top. Charts of the month. FMS investor sentiment sinks to 5th lowest level on record. We covered that in our article. We'll do that in detail. Mag 7 valuations are at their lowest level since January 2023, pending new earnings guidance. I think the guidance might come down a little bit more, so this might not be an accurate number yet. But I'm not going to lie. I keep looking at Amazon and even NVIDIA when it got under 100. Time will tell. I'm not doing anything there yet because there's so many better opportunities. It's like all those you can buy, and if we're right and we trade back to the top of the range, maybe you make 30, 40, 50%. But I'm not really willing to commit any type of capital ever unless it's at least a double, if not a triple plus. Even if I have to play the time arbitrage game and it takes a few years, I just don't take risk for 30 to 50%. It's just not what I do. Valuations of all major indices are now below their 10-year averages. That's fascinating, with small cap having the largest divergence of 24% below its discount below its 10-year average on the forward price to earnings ratio. April 9th was a record for advancing declining volume. That was that day when Trump said now's a good time to buy stocks. And I think that tweet is going to go down in history because, it did coincide with the low. Okay, then you got to bounce, then you're kind of consolidating. And I think we're going to resolve higher, either immediately or over time. That's the history of Trump. Volatility followed by upside resolution. 1 month later, you're up on average 5.2%. 3 months later, 11.9%. 6 months later, 18.2%. And 12 months later, on average, up 29.2%. So hang on, we're on the Disney ride, and we're getting to the exciting parts here. Scott Brown. Last week, S&P opened lower by 2%, closed up more than 5%. May 1970 was the only other time we've seen that. It marked a multi-year low, and stocks gained an additional 56%. That's a very small sample, Scott, but thank you for your service. All right, Big gains tend to lead to much higher prices. Here was what happened after 5% gain. Very similar type of chart. So you were down a little bit 5 days out, but a month later you're up. 3 months later, 6 months later, you're up almost 11%. 12 months later, up 27. So the history supports good things happening. Car dealership securing a loan hasn't been this easy. That's surprising. Car dealership guy, April 14th, securing a car loan hasn't been this easy since December 2022. Access to auto loans pre-tariffs improved 3.1% year over year in March, thanks to increases in approval rates, subprime loan share, and down payment percentages. But the number of borrowers who owe more on their loans than their cars are worth also continues to rise. And with the tariff uncertainty in the mix, only time will tell how this loosening will last. By the way, that's really good news for us, because if people are upside down on their cars, they can't unload them in the used car market. Because they got to pay off the loan, which means the supply of used cars, in theory, should go down, and the supply of new cars with better terms and incentives is going up. So you might find a scenario where the people with used cars have to hold on to them, which is what helps Advance Auto Parts. And the people looking to buy cars, used or new, wind up getting better deals buying new cars versus used cars. And that helps Cooper Standard volumes. So I like that. Percentage of overbought and oversold stocks in the S&P 500. Again, you can get the sense there. Volatility index closed above 50. The returns just get huge. 1, 2, 3, 4, 5 years out when you buy stocks after the VIX closed above 50. It's day and night. I mean, you're talking a 55% spread if you did it 5 years out. Buying stocks when the VIX is below 50 versus buying stocks when the VIX is above 50 like last week. Pretty awesome. I'm super excited for everyone that's with me, and I'm super excited for the ones that topped up a bit and came in fresh as well. But everyone's really going to do well based on where we are. Most strategists see S&P rebounding by year end. Widest gap in sell side S&P 500 targets this century. The last time you had this big a gap was 2009, 2002, and 2009, 2022, and 2002. All times were times to buy. This is kind of funny. Democrats' 1-year inflation expectations are 8%. Republicans' 1-year inflation expectations are 1%. I mean, it's unreal. I mean, people making investment decisions on the basis of their political outlook is super dangerous. And I had to tell people during the Biden administration, oh, he's going to destroy the country. I'm like, yeah, but stocks are going to go up. So have a nice day, go take a chill pill. And same thing here. Trump's going to destroy the world. Yeah, but stocks are going to go up. So go take a chill pill. It'll get resolved. Retail flows as a percent of aggregate market cap. All right. Companies issuing EPS guidance, earnings season. Okay, so they're still doing some level of guidance. Here, this shows you drawdowns. Pretty normal in the scheme of things. Ratio of insider buyers versus insider sellers. Insider buying is picking up pretty materially. China retail sales and exports grew faster in March in the face of Trump's tariffs. Retail sales were the highest in over a year. Industrial production was the highest in multiple years. Policy uncertainty index versus the S&P 500. So when policy uncertainty peaks, tend to be near bottoms. China first quarter GDP tops estimates at 5.4% as growth momentum continues amid tariff worries. 63% of FMS fund managers survey investors expect China's stimulus to boost growth in the second half of 2025. We agree. China retail sales value turning right back up. That helps Alibaba. S&P 600 quarterly EPS growth. Bottom-up consensus. So Q1 they're taken down, and they think it's going to come back back-end loaded. We agree. S&P EPS impact, depending on the increase in tariff rate. Okay, so you're looking low end. $7 to $7 to $35. All right. United States, they've already taken it down 7. United States retail sales year on year were solid. They say that they're not confident, but they keep spending. So that's the difference between the hard data and soft data that we've talked about. CEO confidence has fallen to its weakest since the great financial crisis. This guy's always bearish. And by the way, the last time it got this low was 2022, fall 2022. Many of these folks were super bearish in the hole in 2022, and that was the time to buy, not to sell. Manufacturing, someone's American dream. America would be better off if more Americans worked in manufacturing. That's funny. All Americans and Republican-leaning Americans all say 80% say America would be better off if more Americans worked in manufacturing. And then the percentage, so that's 80% of people. And then 20% say, I would be better off if I worked in a factory. So it's like, someone else should go work at the sweatshop, not me. But so you kind of got to put this in perspective. I kind of joke with my friends. I said, look, we want people to install the robots, program the robots, monitor the robots, but not become the robots. So we got to be careful on the type of policy that we wish for. Total foreign holdings of U.S. equities, treasuries, and U.S. credit. Foreigners own 18.5%, 20% of the total equity market, 30% of treasuries, 30% of corporate credit. Dollar index and U.S. 10-year yields. Dollar index has been rolling over materially. This 10-year yield bump was kind of a malfunctioning of the treasury market, which got resolved so far, but has the administration on notice to get a deal done. All right, median S&P stock bid-ask spread, highest since 2020 lows, 2020 COVID lows. That was a buying time. Russell 3000 liquidity, lowest since COVID. So these are things that you're going to see. If we don't get a deal soon, you're going to see liquidity facilities announced that are going to basically be QE under a different name. But you can't QE your way to consumer confidence and earnings power. So that will be a temporary solution if they don't get their act together and take yes for an answer. Unbalanced world, share of global consumption and manufacturing by regions. You can see that this is the balance that Trump wants to work out. We're going to talk about that in the article. Dollar change 2025, worst start to a year since 1995 for the US dollar. That was part of one of our key themes coming into the year. US dollar weaker. Treasuries get bid. Okay, that started to happen except for this malfunctioning in the last week. Value outperforms growth. International outperforms US. Small outperforms large. So the latter hasn't worked. Many of the former have. I think the latter comes to play once a deal's inked. Stocks are not vote winners for Trump. Middle wealth income households only have 10% of their assets. The other thing that they have to keep in mind, one, that we've said, if they push this too far, we will have a recession, and it will be an absolute slaughter fest in the midterm election. So companies will then be able to, they won't have to wait 3.5 years to wait out Trump for making their investment decisions. They'll have to wait 1.5 years because they will have absolutely zero power after the midterms if they don't do a deal. If they do a deal and they do this grand package, it could be another sweep, which means they'll be able to get everything done, including taxes, including everything else. So all these things are in flux, but point to, it's kind of, you can have the good outcome either the hard way or the easy way, your choice. And Xi always chose the hard way. We're going to see if Trump follows the same pattern, but eventually Xi got his ass handed to him and had to flip the switch and shift his policy last year. And we saw equities follow and do the right thing after he had exhausted all other possibilities. And we're going to find out Trump seems to be more proactive. He likes to get the wins without the pain, or at least as much of the pain. And, volatility followed by upside resolution. Valuation discounts to small caps relative to mid cap. I mean, these, you haven't had this opportunity since 2001, which we keep going back to. And that was a record, the next 5-6 years, record outperformance for small caps. So ignore at your own underperformance peril. S&P stock performance in 2025. So obviously defensive have done well. If you back this up a month, this would look entirely different. Cuts like a knife. Net revision momentum for stocks, 12-month forward earnings per share. Obviously, everyone's downgrading estimates in the hole. Just like you saw Goldman Sachs on Monday, they put out a recession call at 1 p.m. and then at 1:30, Trump tweeted, "We're going to do an exemption for the electronics." And then 2 o'clock, they said, "Did we say recession?" If you can't take a joke. And then 2 days later, they said, "Well, yeah, I know we took back our recession call. Now we're going to have a recession." I mean, these guys are clowns without a circus. And I sympathize with them because it's not easy to make decisions when the earth keeps shifting underneath you and the rules of the game are unknown. So I definitely empathize with them. But you got to be less reactive, and you got to look at, Charlie Munger, big fan of and student of Charlie Munger, is if you understand incentives, you can get a good sense of outcome. And, if you look at what are Trump's incentives, what are Xi's incentives, what is the world's incentives, eventually you know where this is going. The question is, do you know what you own so you can hold on long enough to get the benefits of where any rational thinker would know this is headed? And if you get there, then you use these opportunities to be better positioned than everyone else when it finally occurs, which is what we've done. If you don't know what you own and you just trade on price and momentum and what the crowd does, and you're a sheep get slaughtered. And that's what happens. You sell in the hole thinking you're going to be cute and buy lower, and you think you're going to be able to time everything. And those people just get destroyed. They get carried out on stretchers, and then the thing is back at new highs, and they're not benefiting, and they're permanently impaired forever. So that's what we try to help you avoid each week with Hedge Fund Tips with Tom Hayes. Okay, so a lot of people are feeling pain. Both the 60-40 portfolio hasn't worked because of that malfunctioning. It will work over time. You've always had periods like this where that happens. Eventually it recovers. Bear market lows and forward returns. So you can see here, average 12-month out, 45.8 off the low. Top 10 airport signs of weakness in arrivals. This is people coming into the U.S., so we're kind of hurting ourselves that way. China's GDP growth beats expectations for the first quarter of 2025. Like to hear that as an owner of Baba. Retail sales boosted by government subsidies in China. The game is on, ladies and gentlemen. Money goes where it's treated best. And the West is in austerity. West meaning the U.S. right now is in austerity. The East is in stimulus. And that's where equities are going to do the best. Foreigners own 33% of the U.S. Treasury market. So good luck on overplaying your hand in negotiations with that. Market expectations for Fed funds rate keep coming down. Retail sales change. What was the biggest one? This was in March, ladies and gentlemen. Motor vehicles and parts. Cooper Standard, Advanced Auto Parts. Number one, over 5% retail sales growth. U.S. Retail Sales Diffusion Index, positioning across sector groups, healthcare positioning. This is going to be a buy, by the way. Soft data diverging from hard data. This is what I said, the difference between people, what they say they're doing and what they're actually doing. What they say they're doing is the world is coming to the end. What they're actually doing is buying stuff. Oh, it's going to be a Great Depression. I got to go get a car before tariffs come in. Still can't get a restaurant at a reservation without a week notice in Orange County. I mean, it's mind-boggling. Atlanta Fed GDP now estimate negative. Okay, so that'll be 1 quarter up to Trump if it's going to be 2 quarters and get an actual recession. I doubt it. Prime book, consumer staples, interest over time. This is interesting. Taobao, look at this. Google search has gone from flatline to off the charts in the past month. There is on TikTok, all the China manufacturers are rebelling against the Trump tariffs, and they're basically screwing all the Nikes of the world and saying, hey, come into my factory. We get like $10 for every shoe that Nike buys from us, and they sell it for $140. So if you're worried about 100% tariffs, here's our link. Just buy directly from us. Even with the 100% tariffs, you'll pay $20 versus $120. I mean, if Trump plays his hand too long, this could lead to a lot of branded companies going out of business. I mean, LVMH, they had fake purses, $30,000, $40,000 purses for $2,000. I was watching these. Maddie Mills told me about it. I'm like, no, I Steven posts on TikTok for me. We have a huge channel. I never really go on TikTok. But there you go. All right, on to the next. Warren Buffett, someone sitting in the shade today because someone planted a tree a long time ago. And those of you who planted your trees in 2022 and 2023 and today, when we look a year, 2 years, 3 years out, you're going to be sitting in the shade, smiling so wide you could eat a watermelon sideways. And you'll look back and say, yeah, I had some white knuckles. Boy, that was an uncertain time. But I knew the businesses we owned, they'd come out stronger, even in the worst case scenario. You know, we're not buying a bodega on the corner that if Trump throws us into a recession is going to shutter and be taken over by a new owner. We are buying the biggest public companies that have brand ownership in their spaces. So if it got bad, all their competition, their smaller competition that are non-public, et cetera, are going to go out of business and they're just going to pick up share. So either way they win. If we don't go into a recession, they're already the best, so they're going to rebound the fastest. If we do go into a recession, they're going to win over a longer term because they're going to buy up all the people that went out of business or gain share, one or the other. Okay, so here's Slumer. Thanks to my friend who sent this over. Looks like we're at support here on the S&P. Here's our year one of the election cycle. It tends to be terrible into the 13th week. That's why we're talking to you in early February. Buckle up, Buttercup. So we got this for sure, little bounce, and then we got down further. So here we are. It's make or break time. Does this hold up and shock everyone and follow its normal seasonal pattern? We're going to find out. What is it? Well, maybe we crashed off of Liberation Day and will rally off Resurrection Day. I mean, who knows? But I'm sure that will be stolen. That quote will be stolen if it holds to be true. All right, we got that sell-offs. You can see here percentage of stocks above their 200-day moving average, deeply oversold. These are bounce modes, bounce modes, bounce modes, bounce modes. So you look at these, probability weight. Sometimes it takes a little longer. Here's another thing. VIX index again got up to 60 and change. If you're not a buyer when the VIX is 60. I don't know what to tell you. Like, find another hobby and hire someone who can do it for you, who, number one, was never handed a FOMO gene, and number two, has ice in their veins. For better or for worse, that's my genetic composition. Equal weight, Russell 2000 again, MSCI Europe bouncing. So this all looks okay. DAX, I wouldn't be a buyer of the DAX. Tokyo, they've got a huge trade surplus. We're going to take some of that from them. And so is the rest of the world. Tokyo Stock Exchange bounced off the lows. Hang Seng, same thing. 10-year yield bounced up to 450. Probably that's it. When this gets resolved, probably falls back down. I mean, this was just a malfunctioning week, and I think it's going to back off pretty quick. Dollar index getting close to the bottom of the range. Will it break through? If they deval, I mean, it could go down to 88, which would be pretty awesome for emerging markets in China. DXY, it's right here at support. Let's see what happens. Canadian dollar, all the loony skeptics, look what's happening. We got to overcome this resistance. I think you're going to be very, very happy over the long term. Euro, and you'll be sending Trump a Christmas card. How's that? I know you don't see that right now, but USD, Chinese yuan. Okay, so they weakened. Look, they just said, oh, okay, you want a tariff, blah, blah, blah. We'll be weak ahead of it. Tariff away, and then they'll strengthen the yuan back to where it was before, and Trump will declare victory. Oil looks like it's bottoming out here. Gold looks like it might be peaking here. That's what gives me a little more confidence that there might be substance to these rumors, but we'll see. Copper has a PhD in economics. It's bouncing off the lows here, probably off of China GDP numbers. Apple bounced and rolled over. A lot of these are bouncing. I think they trade up to the top of the range. I don't know much more than that. And like I said, I'm not really interested in 30 to 50% moves. I'm interested in 100, 200, 300% moves. But they look interesting, that's for sure. BABA bounced to support. Now rising, it takes out 120. We're going straight back up. 10 cent. Blackstone, and a lot of these great companies just got pounded, and that's opportunity for those of you who are paying attention. All right, thanks for that. I think we got an update from today. What is this? Gold to copper ratio. Yeah. All right. Chance of rate cut down to 72% after Powell's beautiful speech yesterday. Happen to agree with Trump. He's far too restrictive. I mean, by the way, the last time headline inflation was this low, 2.4%, they started cutting with 50 basis points of cuts. So when I talk about, quantitative tightening is effectively over with only $5 billion a month of tightening relative to whatever they were doing, $35 billion. Whether they start easing or not will depend on the deal announcements across the tape. Buffett, most people get interested in stocks when everyone else is. The time to get interested is when no one else is. You can't buy what is popular and do well. We continue to emphasize. Markets gripped by pessimism as bearish sentiments breaks 35-year record, remains above 50% for 8 straight weeks. Last time it did that was the early 90s. That was a buy. Anything close was 2009. Generational buy. 2002, 22, huge buy. Favorite chart of the month. He's talking about VIX volatility plus AAII bears, record fear, and then he just shows what happens in the next 52 weeks, 20%, 19%, 59% up, 36% up, 11% up, 21% up, 21% up, 30% up, 24% up, 21% up, 33% up. When you back up and you burden yourself with the facts, just like the hat says, good things happen. Okay, here's from JP Morgan. Thanks to John. China e-commerce, March 25 online sales, accelerated growth concludes solid first quarter 2025. China's online retail sales in Q1 increased 7.9% year on year. On a monthly basis, online retail sales in March grew 8.9%. Okay, who's the toll taker? 40 cents of every dollar goes to Alibaba in online sales, online physical goods. Gross merchandise value increased 5.7%. Online physical goods, 6.9%. Overall retail sales, 4.6%. So look, and then they go on to upgrade Alibaba. Is this the same report where they upgrade Alibaba? I don't know. One of them upgraded Alibaba this week. I thought that showed a little sign of courage, which was nice to see from the sell side. Alibaba's Taobao surges in popularity as in U.S. as Trump tariffs boost Chinese shopping apps. All the unintended consequences. These politicians are, it's mind-boggling. We now made them effectively independent in chip production because of the restriction. So now they can go hog wild on AI, and they've beaten us in AI between DeepSeek and Alibaba's models and Baidu and Tencent. That wouldn't have happened if reactionary U.S. policy didn't force them to beat us in those areas. It's like we're forcing them. We're trying to stop them, and we're forcing them to beat us. It's just so silly. We'd be better. Well, I'll leave it at that. Some things are better unsaid. So, boost consumption. All right. China open to oh yeah. So Chinese boosting consumption. We've talked about. They want to get up to 70% domestic consumption in the next 10 years. China open talks if U.S. shows respect, names point person. Could you imagine? It's like a clown show. You got trying to cut a deal, and you have 7 people talking on behalf of the president and only one guy with decision-making power. If you're trying to sell your business and they send in some junior VP who's 27 years old with his clipboard to do due diligence, you're like, are you signing the check? No, get the hell out. Get your CEO who's actually going to do the deal or not do the deal. If you want to do due diligence, I need to talk to him. I don't want to talk to the 26-year-old. And basically, Trump's got a lot of quote-unquote 26-year-olds running around with clipboards that have absolutely zero authority, just wasting time. Fundamentally, Xi and Trump need to get to the table. Trump and the Prime Minister of Japan need to get to the table on the phone. And the 27-year-olds can work out the details, but not really have any say or power, because it's just a complete waste of time. It just leads to retrading and deals falling apart. Complete waste of time. Decision makers only, please. Trump spares smartphones, computers, and other electronics from China tariffs, so it showed some flexibility earlier in the week. That's what we covered on BBC. China's stock rescue in full swing as ETF inflows hit record. China's strong GDP growth fails to stem calls for urgent stimulus, which they are doing. Alibaba-backed AI startup Zippo targets IPO as soon as 2025. Like I said, Alibaba is the greatest way to play AI startups because they've got equity in all of them in exchange for compute power that they gave to them. China's March lending jumped on government stimulus push. Alibaba Quark surpasses ByteDance Dubao, DeepSeek as China's top AI app. That's Alibaba's Quark is China's top AI app. US NVIDIA H20 restrictions could be a shot in the arm for Chinese AI chips. Okay, and unintended consequence of ill-planned policy. Investors haven't been this bearish in 30 years, B of A poll shows. That's from Hartnet. That's the bearish level. And that's, if you're not buying during those times, hire someone who knows how to buy during those times. That's the smartest thing you can do. Dollar bearishness reached its highest level since 2006. Just the beginning. Ford and GM stocks pop after Trump says he's looking at an auto tariff pause. Global electric vehicle sales jumped 29% in March. U.S. retail sales jumped by the way, that helps not only Cooper Standard with their China exposure and European exposure, it helps Albemarle. U.S. retail sales jumped by the most in 2 years on car buying rush. Car buying rush. Did you think you would see that headline? It's like all of these bad policy decisions are going to be net benefits to us. Intel to sell majority stake in Altera for $4.46 billion in fund revival effort. Lip Bu Tan is taking massive action quickly. It's going to work out very nicely with him. why we think the market's outlook for housing stocks is overly bearish. This is from Morningstar. We agree, but we would not play the warring factions home builders. We would play the arms dealers like QXO, Generac, Stanley Black & Decker. We have a lot of exposure to this directly, indirectly. U.S. power use to reach record highs in 2025, 2026. Comstock, baby, Comstock. Trump pushes trade partners to buy more U.S. energy as a way to avoid higher tariffs. Duh. Okay. Comstock, baby. All right. Don't fight the data, stock market and sentiment results. Covered all the media stuff. Bank of America Fund Survey. Top 5 things, top 5 points. Number 1, FMS investor sentiment is now at its 5th lowest level on record, only behind the 2009 Great Financial Crisis, 2018 trade war, Silicon Valley Bank lows in March of 2023, all of which were significant buying opportunities. You can see all these low levels were huge buying opportunities. 2022, 2009, 2011, 2016. By the way, it's interesting. Remember I talked about as a possible analog 2011, if this was going to take 8 months to get back to new highs? It's barely a blip on the long-term chart. And if it's 2018, it's more like this kind of abrupt down and abrupt recovery. So you can see those cash levels back to 4.8%, biggest 2-month jump since April of 2020. Generational buy opportunity, all coming off the 15-year low in February. FMS allocation lowest since July 2023. Opinion continues to follow trend, with 73% of investors now believing the theme of U.S. exceptionalism has peaked. U.S. stock outperformance doesn't mean U.S. exceptionalism. I'm not going to say never, but I'm going to say never. Not in our lifetimes. Why? Because never in the history of humankind have you had this melting pot of the greatest ideas and the risk-taking people from all around the world that wanted to come here for a better life. You can't replicate that. All the other countries are homogeneous for the most part, and they're set in their ways, and it's generational, and the ones that have been there for generations. This is such a beautiful country, and it's predicated on immigration. So I hope we don't screw that up, okay? Because we need the best and the brightest who want to come here, to be here, to create their businesses, to create their jobs, to buy their laundromats, to do their dry cleaners, to do their tech startups. That is what makes America great. There's something in their DNA where they say, yeah, I grew up in Mumbai for 18 years, but I'm going to risk it. I'm going to leave all my family and all my friends because I'm so ambitious, and I'm going to go to the promised land in America, and I'm going to, with $100 in my pocket, and I'm going to gamble. Or I grew up in Shanghai or some rural town, and I studied a lot of math, and I'm going to go to America, and I'm going to see if I can start something up that could change the world. And if I fail, I'll have, $50 is zero, and I'll go back. People with that type of DNA that were willing to leave everything behind, to take a risk, to bet on themselves, you can't replicate that. And we have natural resources, and we have natural defense. So yeah, U.S. stocks are going to underperform relative to international for a little while, but U.S. exceptionalism isn't going away anytime soon. 63% of FMS investors now expect China's stimulus to boost growth in the second half. We agree, and it could be even the first half, despite this embargo for the last 5 days. Besant does a great job explaining what a deal could look like. Pay attention. We'll see if the deal, and those are some of the components that I covered earlier in the show. The general idea behind a potential deal would involve China focusing more on domestic consumption and less on state-subsidized manufacturing, while the U.S. cuts back a bit on consumption and builds up its manufacturing base. Looking at the chart below, it's pretty clear why this rebalancing makes sense for both sides. So you can see U.S. consumption all the way out here, U.S. manufacturing all the way down here, and China is just the inverse. Eurozone is actually pretty equal on consumption and manufacturing. And I think basically what you want to see is the world get closer to all being even, like the Eurozone. If you've been with us for a while, you know this shift in China towards a consumption-driven economy is something we've been talking about along with the Chinese government for a long time. In fact, Chinese government has been made boosting domestic demand, particularly consumption, Alibaba being the toll taker, the top economic priority this year. That's why they took Jack Ma out of hiding and gave him a medal a few months ago. Right now, Consumption makes up about 55% of the overall GDP in China compared to 70 to 80% in wealthier nations. China's aiming to hit 70% by 2035. I can't emphasize enough how massive this shift toward consumption really is. To put it in perspective, China's GDP in 2024 was 18.8 trillion, with consumption making up about 55% or 10.34 trillion. If they hit their target of 5% growth this year and then slow to 3% annually through 2035, reaching their 70% consumption goal would mean $18.57 trillion in consumption alone by 2035. Let that sink in. That's an 8.23 trillion jump in new annual consumption. Consider 40% goes through BABA. That's 3.5 trillion. You do the math. That's another $300 billion of earnings. Put a 10 times multiple on that. Plus their existing business, plus their AI, you got a $4 trillion company. So while everyone's waiting for NVIDIA to hit 4 trillion, you might be waiting a long time. It wouldn't be shocking on those numbers. We won't be around when it's at 4 trillion probably, and maybe we'll have a little trailer on it. But so who's the best position to benefit? Alibaba, the toll taker of the middle class, holding 40% of the e-commerce market, still growing. It's hard to imagine they don't capture a massive slice of the pie. So clearly, this shift is coming, is something that they've already been working on with or without a deal. The article below explains it in detail. You can read the Bloomberg article. So here's how we see it. If a deal is reached between the US and China, we'll probably see an even bigger push towards domestic consumption in China. And if tariffs stick around, China will have no choice but to shift towards consumption to make up for the hit to export-driven GDP growth. Either way, Alibaba will be laughing all the way to the bank. It's also worth pointing out that China has a pretty powerful toolkit to speed up this shift towards domestic consumption, namely the long-awaited and much-rumored bazooka-style stimulus. Unlike its Western counterparts, China didn't pump out stimulus during the pandemic, so they have plenty of room to use both monetary and fiscal tools. That's a luxury US and Europe just don't have, and the market seems to have recognized and begun to price this in. So you can see here, government debt to GDP. In fact, maybe this is why the Chinese government held back on pulling the trigger. Perhaps they saw a potential Trump 2.0 term and a trade war on the horizon, so they decided to hedge their bets and keep some of the ammo in reserve. Either way, they have the tools and more than ever, good reason to use them. It's over $20 trillion sitting in household deposits waiting to be spent. It's time to unleash the bazooka, shifting from domestic consumption and stimulus to a less exciting topic. We figured out it'd be a good time to address the elephant in the room, something we thought was in the rearview mirror, which is delisting. Rumors began circulating this past week after Fox Business senior correspondent Charles Gasparina published a tweet below. Charles is a fantastic journalist, really good guy. I've had dinner with him before. I know him. And he's just reporting the information that he gets. And then Brendan Ahern put out an article the next day breaking down, look, there is a desire. It's certainly a negotiating chip. I don't see a deal where China and the US cut a deal and China's access to US capital markets is removed. That is the nuclear option. If Trump cuts off their access to US capital markets, I think the trade war turns into a hot war. I'll just put it that way. But the joke will be on the US, because the only people that get hurt if they delist the US ADRs is US investors and pensions, not the Chinese who own it in Hong Kong. So that would kind of be like if you're China and you're competing with the US, the best thing that could ever happen to you is they delist your stocks, because number one, you just take your business to London and Hong Kong and international money will find you. It goes where it's treated best. Number two, $800 billion of investor capital of your opponent has been evaporated. And so, could there be people that stupid in the administration that would move forward with this? Of course. So we're going to talk about how you hedge against that. Is the likelihood there that there will be no adult in the room to explain to them in English, like to a 3-year-old, what happens if you actually do this to yourself and you point the gun not at your opponent? It actually has a reverse hosel that points right back at you. We think so. And we know that the right people are going to go down to Washington and explain this to them, because it's understandable you would think this is a way to hurt your enemy, but, they tried it with semiconductors and it was the worst thing they ever did. Hopefully they learned from their mistakes. So Brendan Ahern, good buddy of mine, he runs the K-Web ETF, #1 ETF for China Internet. Put out a great article the next day breaking down the rumors and laying out the facts. He also hosted a tariff briefing webinar that covered, among other things, delisting fears. I highly recommend you listen below. talks about, we've been to this movie before the last few years. They went through the PCAOB, et cetera. Part of it has to do with Atkins, the new SEC chair, getting votes. He won by 52 votes, so it was a tight vote, and some of the people that put him over the top would like to see him explore this issue further. So he's going to do that for sure. Whether what he finds after exploring, many months later, is another discussion. The other risk you have is an executive order. So that's that. We're going to tell you what we're doing around that in a second. Fears around delisting are nothing new. We went to the same cycle back in 2021, 2022, end up with the Chinese government stepping in, changing its laws to allow the PCAOB full access to inspect the U.S.-listed Chinese companies. Alibaba, along with nearly 300 other ADRs, passed those audits with flying colors. Now that the PCAOB has had access to over 2 years, it's tough to see logical case for delisting. The other funny thing is, the administration has this fantasy in their mind about golden shares, that the PRC owns big slugs of these companies. And the fact of the matter is, all you have to do is look at the cap table, okay? They certainly influence. I understand that. That's just like Trump is influencing Apple and NVIDIA and shaking them down to invest in the U.S. That's kind of a good thing, but they don't really have a choice in the matter. It's like, do what I say or you're dead. Offer they can't refuse. So I don't see how that's a whole lot different. But the fact of the matter is, there are a clear number of shares outstanding. There is a clear net income, and the net income is divided by those shares outstanding, which are disclosed in the public filings and the public holdings of who owns the company. So where this fantasy phantom owner is, it doesn't make sense, because when I divide share count by earnings power, I get the exact number that they publish on the website, along with every other company. So do they influence? Yes. Do they maybe have seats on different boards? Yes. Does the U.S. influence our major companies now? Yes. Less so a few months ago. Now it's a major factor. A little bit autocratic if we're being objective about it. But as far as them owning shares, it just doesn't foot. I mean, you could have a fantasy in your mind that that's the case, but if EPS matches S, it is what it is. Okay. So, okay. So now that PCAOB has had access to their data for 2 years, it's tough to see a logical case for delisting. And betting on delisting or calling China uninvestable has been your belief the last couple of years. It hasn't been a profitable one. But just as we discussed in last week's article, we need to burden ourselves with the facts, not the rumors, not the noise. What are the actual facts? And here they are. U.S. ADRs are held by U.S. investors, not the Chinese government or Chinese investors. Over $800 billion of U.S. investor capital sits in 286 China ADRs. Delisting China ADRs would do nothing but vaporize nearly $1 trillion of U.S. investor capital, including pension funds for teachers, firemen, police officers, etc., union workers, okay, manufacturing people on the assembly line, all while the Chinese government laughs all the way to the bank. You basically just took the gun out and shot yourself and took $1 trillion out of your firepower. Two, on the flip side, China holds $1.3 trillion worth of U.S. treasuries and about $370 billion worth of U.S. equities. They could easily liquidate these in retaliation if lowering the 10-year yield is this administration's top priority. It's hard to believe they would cross this line and open the door for such retaliation. It's natural to make threats when you're negotiating to get what you want, but doing so would be the equivalent of shooting yourself in the foot on the world stage. And three, the U.S. has the number one capital markets in the world because rumors like this don't happen. Foreign companies, whether from China or elsewhere, pay enormous fees to list in the United States and go through all the regulatory hurdles and vetting. Weaponizing delisting for political purposes wouldn't exactly encourage foreign companies to IPO or list here in the future, and it would undermine the strength of American capital markets. Basically, you just push tens of billions of dollars of business to London and to Hong Kong. So maybe that's another reason to be ex-US equities and looking at opportunities in UK and Hong Kong. Now, If fears over delisting are keeping you up at night, BABA shareholders can easily convert their US ADSs to Hong Kong listed shares. There is no real downside to doing so. A step-by-step guide directly from Alibaba is listed below. Again, we see this as an unlikely scenario and a hard line is in the sand. What really matters is that you focus on what you can control. And when you buy high quality businesses, when they're marked down, good things tend to follow. Alibaba is no different. So what we are doing, it's really funny. Literally a month ago, I was going to call our custodian and have all of our Hong Kong shares that we converted during this first fear converted back to BABA ADSs. And I was like, let's just hold off. So now I'm going to make the call. I have made the call. I put it in 2 days ago. We're going to convert all of our US ADS shares to Hong Kong, not because we think anything's really going to happen, but we want to hedge against it. But we are keeping 100% of our US ADS derivatives because we really can't replicate the upside in those in any other instrument, and we can't replicate them in Hong Kong. So where we come out is, as a fiduciary, we want to hedge our downside. If a nuclear option happens and it was some executive order delisting, our options are probably wiped. But because we own the shares in Hong Kong, over time, the equities on that theme, China, ex-US, will dramatically more than make up for getting wiped on the derivatives. So we have to hedge it so we can keep the derivatives. If I had to assign a probability of a highly stupid decision, I'd put it at like 7 to 12%. But by straddling, where most of our money is in the equities and putting that all in Hong Kong. So if we lose on the options, the stock over the next 2 years is going to make multiple times of that back and multiple times on the overall invested capital of both the derivatives and the stock. So that theme and position in the portfolio will do net exceptional, even if the worst case scenario occurs. And then if the best case scenario occurs, which is they just leave it alone and let markets do what markets do, we'll be at no disadvantage by owning the stocks in Hong Kong, and we'll get the additional kicker benefit from all of our options and derivatives based in the US. So we'll get 5 bites at the apple versus 2 bites at the apple. And that's the best way I could think of it, because there's no other way to express the expected value on that little pocket of derivatives than the way we have it set up. And we want to ride that. And we think that the odds are in our favor, but we're hedging it out. And if they're not, and the nuclear option comes, we are prepared for it. We have the stock to ride prospectively in Hong Kong, and it will more than make up for the loss in the US ADS issue, which again, we assign a very low probability. So if I've got a 10% probability, I'm not going to give up a 5 to 7x expected value over the next 12 to 24 months. I'm just not going to do it, especially when the percentage of the overall assets is small, but the upside is so big. And that's how we're just managing it as fiduciaries in that pocket of our portfolio that's dedicated to China, to just hedge against any very small outside risk, but nothing risk. And that's all we can do. So the earth shifts underneath us every single day. It doesn't change the underlying business. The underlying business is only going to get better regardless of the outcome. But how do we ensure that we're in a position to guarantee take advantage of it, and more likely than not, take advantage of it in every single way possible under the sun? And that's really what we want to do, and that's what we are going to do. So that's how we're dealing with it. You do what you do. I mean, I wrote out PCAOB with a ton of US ADS and really didn't blink, because I knew if there was a legal respect and framework that ultimately it wouldn't be delisted, and that's exactly what happened. I have to be open to the de minimis possibility that a legal framework is not respected. And that's why we've taken action and made the request 2 days ago and should be executed shortly. So, and my guess is at these levels, I mean, we bought plenty of BABA last week, by the way. That'll become 9988 probably tonight or tomorrow. And we look forward to buying more. So nothing in our thesis has changed. Where we hold the bulk of our money that's committed to the idea, i.e. in the stock, is going to change just as a hedge. And because the odds are 90% in our favor that the nuclear option will not be triggered, we do nothing with this small piece of our overall assets that has a monstrous upside expected value of 5x plus, and we're going to just ride or die on that small piece, and that's what we always do in the derivative bucket anyway. So super excited about that. Fear and greed down here, buyer not seller. National Association of Active Investment Managers turning up, so that's good from very low levels. ADR delisting risk back in focus. This is from Goldman Sachs. I think John sent this. I think they go through all the history, basically assigning a low probability. Here are some of the things that would happen. Following summarizes a simplified procedure for delisting from an investor's perspective based on historical precedents. Investors sell before the last day of the ADR trading. After 10 days of the filing of Form 25 with the SEC, investors will be able to freely trade and sell the soon-to-be delisted stock on U.S. exchanges at prevailing market price before the security's last trading day in the U.S. B, investors could continue to trade the shares on the OTC market subject to their mandate and investment scope. For instance, Luckin Coffee, LKNCY, was delisted from the NASDAQ on June 29, 2020, but its shares are still trading on the over-the-counter market. So that is, I think BABA has an over-the-counter version also called BABAF. Which trades in line with the underlying ADS and with the Hong Kong share prices anyway. And any difference will be arbed out, so you don't really have to worry about where it's traded and getting a huge discount, because if there's a huge discount, someone will arb that out over time. C, investors can trade on other exchanges as the stock is listed on a major other exchange and can return their ADS and withdraw the equivalent deposited security, i.e. Hong Kong shares, based on previous cases, even after the effective delisting date. So you don't have to do this now at all. And D, investors receive the net proceeds upon the termination of the ADR program. Investors take no action before and 6 months after. Oh, listen to this. If investors take no action before and 6 months after the delisting date, the depository will commence the sale of ordinary shares represented by unreturned ADRs at prevailing market price if listed elsewhere. So you'll basically get the Hong Kong price in cash and pay the net cash proceeds after applicable fees and expenses to the ADR shareholders. So basically, if you do nothing and it stops trading, what this is saying from Goldman Sachs is they'll just send you your money at the Hong Kong price. But we don't want cash. We want appreciation. And this is just getting started. So, reading this, my inclination is to, again, do nothing. But as a fiduciary, my inclination is to hedge that risk. So so that's that. Energy earnings, look, I have a monstrous amount of personal exposure and a monstrous amount of derivative exposure. I'm doing nothing with my derivatives. I'm completely comfortable with that. With the stock, we do all the same across the board. So so that's how we play out. I think net effect is it's going to be a net positive. And then in 3.5 years, I can convert back to ADSs. Can't make this stuff up. All right, energy, top. Okay, so energy earnings, down 3.9%. Everyone's taking down their estimates. Defense earnings, top 30 weighs down 1.9%. Next year, down 0.6. Those will go back up if we get the resolution. economic data we covered. Estimates have gone from 275 down to 268. So estimates continue to come down. And now we're going to do the Ask Me Anything questions. So for those of you who don't like the Ask Me Anything, we've got a lot of them. It's going to take a long time, but a lot of you get huge value. Stick with us. If you don't, we'll see you next week. Same time, different place, live from Hawaii. And we'll see you then. For everyone else, here we go. All right. That is spam. Okay, next. Ivan. Oh man, I get so many. All right, JT Investor asks, thanks for posting the information on ADRs. Could you please clarify if investing in KWeb fully avoids the risk of delisting? Delisting doesn't really care. Brendan is fully converted his portfolio. Thank you and have a happy Easter with you and your family. Happy Easter to you too. I spoke to Brendan this week. I would say in his Forbes article, he said that I think 16% of his portfolio was US ADS that didn't have a version in Hong Kong that he could quickly convert to. So those would probably just be cashed out and he would reinvest those in Hong Kong shares. So I think it's perfectly fine to be in KWeb as far as I understand. So I wouldn't worry about that. And I would go ahead and go to Hedge Fund Tips, go to the article. I listed his podcast. I'm sure he explains all that. But no, I don't think I'd have any problem investing in KWeb at all. So there's that. And he's a good manager. And leave it there. Okay, so we got Cole's picture. Can you look at Lineage? This is from Gasper Mohoric, cold storage company. Lineage. Okay. Okay, Lineage. Line. Yeah, I don't do companies that haven't been public for many years, to be honest with you. So, I have to see how they operate through multiple cycles because it's very hard. Let's see what the balance sheet looks like. 170 of cash. 6 billion of debt. So that's not a good ratio. To have 100 million of cash and 6 billion of debt in this environment or any environment. So for me, I mean, they're generating a lot of cash. I think you really got to do a lot of work on this to get comfortable with it, and it's not going to happen on this call. So for me, it would just be an easy, quick pass. I'm like, I don't need that to make something like that work. Rao Reynolds. You think Cooper Standard will be able to make up domestic market volume reductions through growth in China partners? Seems like BYD is a customer. CEO reference plants within China. Partially. I don't think you're going to see again, going back to this call, Rao, I don't think it's going to be, I think it's going to be better than expected. I think Q1 was amazing. And I think that making up for the inventories once they come up with a deal here is going to be monstrous. Ken W. Hertz in light of Ackman, thoughts on Starbucks. Let's see. Hertz, I really have no interest in. I hope it works for Bill. and it probably will. He's buying it with enough margin of safety, but it's not a business I want to own long term. Starbucks, SBUX is obviously down on the China. They might have to sell the Chinese business. There's not enough margin of safety for me here. So yeah, it's a good business and everything else. And I wouldn't bet against the Chipotle guy. He's going to figure it out. But, talk to me if it gets down. Well, it's at 80. I was going to say, talk to me if it gets below 100. It's at 80. All right. Let's see. Yeah. I think for the long term, you're okay betting on this guy and this business. But I think you also might have an opportunity to get it a little cheaper. It's a lot of competition, Dutch Bros, everything else. I would just, to say I'd buy it at 70 or 75 and I wouldn't buy it at 80, 85 is pretty silly if it's a long-term thing, but that's kind of where I come out. All right, next. Matt Mitchell, LVMH. I got to say, yeah, I do want to buy these, but after seeing those China manufacturing videos on TikTok, gives me a little pause because kind of the gig is up. I would wait on this. I understand, like, backward looking, it's a complete no-brainer at these levels based on the fundamentals, but I would just probably step aside. Jason Moore, my son and I listen to your podcast each week. Thanks for all you do. AES. Thank you for watching. AES. You got a utility. What's the dividend yield? Pretty sure that's a utility. %7 yield. Yeah. I guess you just got to look at their cap table, but their capital structure for debt refinance, but I generally think you're okay with that 7% yield. Whoa. No, let me rephrase that. What the hell is going on here? I would just avoid this. This is crazy for a utility. Where are these guys based? In Virginia. All right. If you can get unshakable confidence that this negative free cash flow is over, maybe, but this is no bueno. So I wouldn't even waste time on it. There's not enough upside to take that kind of risk. If the upside, if this thing could be a 10 bagger once they get it to cash flow positive, or a 5 bagger, yes, but like to make 50% and collect a 7% yield for possible existential risk, hell no. Chris Williamson, MU looks interesting here, getting close to the bottom of the cycle. Okay, then buy it. I don't know if that's a question or an or what, but I'm not a fan of MU. That's been a you might be right. I just, it's such a cyclic. I'll tell you what's not going to happen is you're not going to get a triple or quadruple. And in Intel, if they do it half right, that's what's going to happen. So why would I screw around with this? Monique, is Charles Payne short, or should have been in the NBA? How tall are you? Number one, Charles Payne is not short. He's tall, handsome guy. 2, I'm 6'5", and 3, I think it's camera angle because, like I said, in his old studio, they did not look like there was that much stuff, but it is what it is. Brian Norman, what are your thoughts on Trump administration considering delisting? We just covered. Delete. Nicholas Wang. with depressed car volumes now for 2020. What are you talking about? What numbers are you looking at? We had record numbers in the month of March. So burden yourself with the facts. Thank you for the question. And thank you for tuning in. Must be in the blue line category where he thinks inflation is going to be 8%. Mr. Hayes. Okay, so he's got a question on Matt Holleran, longtime supporter, wants to do floor and decor, which we did on the podcast a few weeks ago, and I think we said fine. It's a home building play, home building recovery play, and yes, we do like it. Good work. Let me just take a look here. I think you're a little early, buddy, but you're close. So if you're thinking 3 years out, you could buy it here. If you're thinking longer, I'd just wait a little bit. What's the debt like? Yeah, they're fine there. So. Yeah, I think you're okay. I think you can probably get a little better price. I mean, if you get low 60s, you're probably, yeah, I think you're okay here. Good work. Next is from thanks for your Carl Johnson. What would you say are the top 3 or 4 stocks in your portfolio, biggest upside potential? I think you just equal weight 10 good ideas. Obviously, we like Baba. Obviously, we like Cooper Standard. But they're all. This tariff thing created such amazing opportunities, and my clients know which ones are our favorite based on the weighting in their portfolio, and I'll leave that benefit to them. But for listening in, if you like some of the names, just equal weight them, because you're never going to predict which ones go first. Some are going to double in less than a year, and some are going to take 3 or 4 years. But if you've got a basket of them, you're going to do great. All right, got that one. AJ Barali. Cooper Standard has $1 billion in debt in 3 years. Market's currently pricing blah, blah, blah. Yeah, so listen to the interview that I did with them. Welcome to the podcast. You're obviously new. We did 38 minutes on. We did a 1 hour interview. Go to Hedge Fund Tips at the YouTube channel. We discussed all of this. All right, next, Griffin. Griffin Brown says, typically listen podcasts on the way to work. Recently started watching the podcast, and it's much more beneficial. It's like 3 times more valuable to be able to see it versus listen to it. But if all you can do is listen to it, I'm glad to deliver that value as well. Do you typically use Coifin for your valuations and ratios, or do you like to do them yourself using numbers from the 10K? Always go to source numbers if we're going to put, this is just for screening and a quick look to see if we should do real work. But no, everything comes from the public filings, and we double and triple check everything. GTN, that's from Keenan Martins. GTN. Great television. All right. I know the guy who runs this. He also has an insurance company I wanted to get involved in. I understand what you're saying. You're generally right, but there are factors that you don't know. So for me, it's a pass. Tom, you're the bacon bringer. Oh, okay, so this was about the CEO of Intel having Chinese investments through his fund coming under scrutiny. Look, the guy is Chinese. He was vetted by the board of directors. If he has to unwind some of his Chinese investments that his fund is in, he'll unwind some of his Chinese investments. He was on the board. He had the same investments. That was just noise last week. And that's it. So with that said, we'll see you next week. Same time, same place. In the meantime, make it a great one. Bye for now.